Hello, everyone. Welcome back to Chapter 5, CCA. We just finished talking about a bunch of classes. I know I went through the list kind of quick, but pages 277 to 281 of the textbook will allow you to read up paragraphs of the most common classes and get a better understanding. Um, I have a couple slides. We're going to talk about a bit more of the rules. We're going to address AccII, but I really want to get into doing the calculations in this video. So before we start, I want to go to exercise 5-3, a CCA error. So we talked about the various classes. Why does it matter that we put an asset in the right class for CCA? During the tax year end, December 31st, 2025, your company acquired depreciable property of $326,000 that you incorrectly included in Class 1. Early in 2026, you discover the property should have been Class 10. What's the impact of your error on the CCA claim? So we had put it in Class 1. So Class 1 it uses a rate of 4%. So 326,000 at a CCA rate of 4%, we only deducted $13,000 for CCA. That's how much we removed from our expenses. At a general CCA rate or a general tax rate of say 27%, 13,040 times 0.27, which means we saved a little over $3,500 on our taxes. But what would have been the result if we put it in the correct class? We should have put it in Class 10. Class 10 uses a CCA rate of 30%. So 326,000 times 30%, our CCA would have been 97,800. So 97,800 times our tax rate of 27%, we would have saved $26,000 on our taxes, 26,406. We put it in Class 1, so we were only able to deduct 320.8 or 3,520.8. So we spent $22,000 more paying off our taxes this year than we needed to. So CCA rates are a big deal when doing business calculations or business taxes. So even though we will eventually pay this $22,885, even though we will eventually pay the amount in the expenses, we can save it. We can defer the taxes for now. We can pay or claim a higher CCA rate this year, save those taxes, and then as our declining balance goes into the future, we'll pay a bit more in the future because we won't have as big of a CCA claim, but we'll be able to defer this $22,000 in taxes till then. So we could have increased our CCA claim by $84,760. So this is important stuff. Let's do the basic calculation, and then we'll go into the AccII stuff. So Radmore, with a tax year, ends December 31st, has a Class 10 UCC balance of $950,000. In 2025, the company acquires 15 automotive vehicles at $20,000 each for a total addition of $300,000. They disposed 18 automotive vehicles for an amount of $144,000. So of our $950,000, we got rid of $144,000 and we bought $300,000 more. What does this do with our calculation? So under the usual rules, we had 950,000, we bought 300,000, we sold 144,000. Under this rule, the half-year rule would have subtracted half, 78,000. We would have taken CCA, 308, and then we would have added back the 78,000. But right now, our accelerated incentive is sort of undoing the half-year rule. So we have 950,000. Our additions will net against each other. So we'll add 156,000 to the UCC balance. UCC of 950 plus 156. Our total UCC is 1.106 million. Taking 30% on that, we have a CCA rate or CCA deduction of 331,800, leaving 774,200 to carry forward to the next year. So going through the slides, the half-year rule says full CCA on depreciable property no matter when it was acquired in the year. But that's a problem if the business didn't exist for a full year. So normally we reduce the UCC, or if the asset wasn't held for a full year. So the solution is reduce the UCC at year end by 1/2 of net additions. So net additions is capital cost of property added, reduced by the proceeds of property sold. When it comes to the half-year rule, Class 14 does not use the half-year rule because Class 14 always prorates additions to the date purchased. So it doesn't need to take a half-year rule because we're already adjusting it. Certain Class 12 depreciable properties are an exception to the half-year rule, so we still just take 100%. If the taxpayer purchased depreciable property from a non-arm's length person, and that person owned it as depreciable property. So when we're talking about the half year, when I buy a new machine, I'm considered to have it for half the year, but the machine must be new to me. If my sibling buys the machine off me, they don't get the half year rule because it's not new to us. We're still part of kind of a same familial unit. So yes, I had the machine. I had it for a couple years and I sold it to them. The machine's new to them, but not new to us. So they don't get the half year rule. If I had sold it to a third party who I didn't know, it's new to them. It's not a new machine, but it's new to them, so they can take the half year rule. So this exception for non-arm's length individuals remove the half year property. Now, instead of reducing the UCC, the accelerated incentive increases the UCC for CCA purposes. When the AccII came into play, it added 50% instead of the half-year rule taking away 50%. The revised rule retains half-year rule for depreciated property not eligible for the AccII. So there can be things that apply the half-year rule, but don't apply the accelerated incentive. So we need to first verify that the accelerated incentive applies. If AccII does not apply, does the half-year rule still apply? If neither applies, CCA rate is based on the rate for that class. So it says, if the AccII does not apply and the half-year rule doesn't apply, then we're just taking normal CCA. If the AccII applies and the half-year rule applies, they'll undo each other, 50% times 2. So we'll take the usual CCA. So in order for CCA to be adjusted, we need to have a half-year rule applying and the AccII's also not applying. Does this sound confusing? I understand. In this course, you need to understand that the half-year rule exists, but the calculations we do, most of them do not modify the CCA calculation, so you can just take the class rate. Just take the 30% or the 20% and don't worry too much about modifying the rate. Net additions is the capital property added that exceeds the reduction to UCC. So whenever we buy properties and we sell from the same class, we have to net them together. So if the half-year rule applies, it doesn't apply only on the additions, it applies on the net additions. So if our disposals, if we got rid of more than we added, that means our net additions is negative, and you never need to worry about the half-year rule or the AccII. So if the difference is not positive, there's no adjustments for half-year or AccII. If the difference is positive, then the half-year rule and AccII applies, but they undo each other, so we don't worry about it. So the accelerated incentive was it meant to encourage businesses to make additional capital acquisitions. It does not increase the total CCA over time. Because CCA is based on that UCC balance, Increasing our CCA rates just reduces that balance faster. By the end, once it's fully amortized, the entire expense that we can have is just capital cost. So it doesn't increase the total CCA over the life of the asset because the CCA total will never be more than its cost, but it allows us to deduct that CCA faster. So the CCA will be higher in the year of acquisition, but it will be lower in subsequent years because the faster we get it deducted, the lower that UCC will go. The lower the UCC, the smaller our percentage rates will be. So there is this question, this flow chart to see when does AccII applies, but basically it just says, is it new? Is it new to you? Is it new? Has amortization been taken on it before? If sold or purchased, did it come from a family member? So is it new? Is it new to you? Has the half-year rule or CCA been taken already? Because if that's true, then you're not going to get the half-year or AccII again, right? It only really applies in the first year. Non-arm's length transactions are situations where the purchases have some connection to the seller. There are times where items can be rolled over. So if I have my t-shirt business was in my name, I incorporated and I want to put those machines into the corporation, I can roll it over. It just means transferring the assets at cost. Exceptions from AccII is class 12. The half-year rule only applies to some items in class 12, but most of class 12 does not use the half year, so it does not use the AccII. And we're going to ignore electric vehicles for now. I mentioned the AccII flowchart. Acquisitions of depreciable property includes capital expenditures, such as extensive renovations. If a terminal loss or CCA previously claimed on property by anyone, AccII is allowed only if rollover is not used and property not previously owned by person. So if it was rolled over into my company, we don't take AccII because my company is me. So it's not new to me. It's new to the corporation, but it's not new to me. If I give it to a sibling or a family member, yes, it's new to them, but it's not new to us. So they just have that consideration. Half year in AccII only applies to new assets. Now, the property itself doesn't need to be new, in meaning that I can buy a used vehicle. I can buy a used machine as long as it's new to me. Enhanced UCC, I'm not going to go through that. A class 12 is a straight line class. The accelerated incentive does not apply to any property in this class. The half-year rule continues to apply specifically for computer software and Canadian films. 100% of cost of medical and dental instruments, uniforms, Chinaware, and tools costing less than $500 can be claimed in CCA as CCA in year of acquisition. So small amounts are really not worth tracking, can be fully amortized in year one. I'm going to stop here because we're going to go through the amortization calculations of class 13, 14, and 53 pretty much all at once. So see you in the next video.